Whoa, what is going on? Let's talk about all of the drama that has unfolded since Friday. If you've been living under a rock, I'm going to catch you up. But everything I thought I would be talking about today is not necessarily the hot topic anymore. So let's get into it. But first, I'm going to rewind back to the beginning of last week and let's kind of go through things chronologically here somewhat. So last Tuesday, Jerome Powell had his testimony talking about the market, and this headline was from I think earlier last week. I don't know. Yeah, March 7th. So Jerome Powell says Fed is prepared to speed up interest rate rises. So that was the big news last week. And basically, he went on to say that they're going to continue their hawkish tone. There will be job losses. And it was a pretty clear message on Tuesday. And then things changed a little bit. Let's skip to Friday. We ended up getting the jobs report, which became quickly overshadowed by some other news with Silicon Valley Bank. But here's what happened. Economists split on Fed's next move after strong February jobs report. One of the things Jerome Powell said is that the new data that we get, not only jobs report, but the CPI that we'll be getting this week is going to be weighed very heavily on their decision of their next move. And I think it's March 21st when they meet next. So what happened with the jobs report? Well, we added 311,000 jobs. 215,000 is what was expected. Unemployment went up to 3.6%, but 3.4% was expected. And wage growth, 4.6% and 4.7% was expected. So this says here, analysts flooded our inboxes with their takes on the report, with some arguing February's numbers indicate the economy is in for a soft landing, while others contend current job growth increases the odds the Federal Reserve will continue their hawkish campaign. And then it goes on to talk about the labor market cools from blistering to just plain hot. The moderation in job growth in February confirms job gains in January were inflated by unusually warm weather and seasonal adjustment quirks. If you remember, the January jobs report was kind of crazy, came in at 500,000, somewhere in that range, and it was a little bit hard to believe. While payrolls remained hot, unemployment ticked up and wage growth was the slowest it has been since before the Fed started hiking rates. The market's initial positive, although tepid, reaction may be a sign that many investors believe the data was not enough to push the Fed to a 50 basis point hike. So that's where we were at on Friday after the jobs report came out. And then Silicon Valley Bank happened. So if you've been living under a rock, Silicon Valley Bank was shut down on Friday, sparks banking crisis fears, but for now, bank's collapse is just a cautionary tale. So what happened here? This talks through it a little bit. Most of SVB's investments were in the bond market and other securities that lose value when interest rates increase, as was the case last year when the Federal Reserve began hiking rates. The bank also focused mainly on tech startups and venture capital firms, which began drawing down their deposits at SVB as tech stocks were getting hit. SVB realized more losses when it tried selling its securities, which had lost value due to high interest rates, and it ultimately wound up in a sudden liquidity crisis. So all of this played out last week between Wednesday through Friday. And basically, the bank did not have the money to give their depositors, and everyone wanted their money back. And so it shut down, and the FDIC took over. Now, I'm recording this on Monday morning, and a lot has changed since Friday to Monday, and a lot will probably change between Monday morning and Monday at 4 when this is posted. So forgive me if I have any information in here that is dated over the next 6 hours or so. But what has happened, U.S. government steps in and says people with funds deposited at SVB will be able to access their money. So as of this morning, they're saying that, basically everyone who had their money there will get their money back. This is an isolated incident. Signature Bank also went down with this as well, which is a much smaller bank, although SVB was 16th largest bank that we have in the US. So a little concerning. And so why does this matter? this is definitely affecting markets, and it affects just fear, right? So once you start to have fear and uncertainty in the market, who knows what can happen? And so ultimately, this will affect mortgage interest rates as well. So there's a lot of different ways to think about this. I've been hearing some people saying that, because of all of the interest rate hikes and how aggressive this was, that is really what landed SVB in this situation. And the Fed is going to have to consider backing off because they don't want to see that happening to other banks. So that could play out. They also say continued tightening is going to be what's necessary. So this totally changes this is another data point that they're really going to be looking at before the March meeting. And this is affecting, markets in general, which then affects mortgage rates. So with mortgages, before this happened last week, applications last week rose 6.6%. So we did see a tick up despite these rates continuing to go up with mortgages. But I think today, on Friday, according to my sources in the mortgage industry, there wasn't a whole lot of change based on this news. So we didn't see rates go in any different direction Friday just because of this. But as of today, first thing in the morning, it seemed like mortgage rates were going to be going down. So just shout out to any of you who are in the home buying process. Check with your lender. This is big news that's happening, and it could totally affect what the rates are, what you could lock in, and also kind of ask them what they foresee in the future, whether or not you should hold off or, maybe jump in depending on where they think rates are going, because they have a much better pulse on the market than I do in that sense. So that's the big drama, you guys. We're going to have to keep up with this because it will totally affect the real estate market, of course. There's a lot of questions out there. Is this a contained incident, or is this going to spread to other banks? Are there other issues out there that we don't know about? And that would affect much more than mortgages. That ends up, investors, real estate, it all kind of trickles down. So we'll see what happens. But let's get into Phoenix. Let's talk about the Cromford Market Index this week. And here we are at 131.7, keeps going up. If you are new here, this reading, anything over 110 indicates a seller's market for the greater Phoenix area. And we've got our look here at demand and our supply, and that's the same idea in terms of numbers. So 83.3, that is about, we're about 17, can I do math today? 17% below normal for our demand, if 100 is normal. And supply, we're sitting at about 37% below normal for supply. So again, it's just showing that difference between supply and demand. We have less supply than we have demand. And this really looks mainly at resale homes. So for any of you asking questions about new construction, I have a video on that. You can check that out. I posted that on Friday, going through what's going on in new construction. So ultimately, with a demand outpacing supply, we've got this situation of a seller's market, albeit a weak seller's market, but we are out of the buyer's market. This reading was below 90 as we started the year, I think, and that indicates a buyer's market. So we're beyond that at this point. Let's look at every city's CMI. These are the major cities that the Cromford Market Index looks at. And every green arrow means it's been improved for sellers over the last month. And so this is the month over month change. The only two cities that saw a decline month over month was Tempe, which is kind of surprising, and Paradise Valley. And recently we had been seeing, I think, Cave Creek and Scottsdale not having improvement over that month over month reading, and they have as we look at this last month. So here's where we stand for all the major cities. The average change month over month was about 12.6% this month. And last month, that average change was 13 or so. So there's definitely been some deceleration in terms of movement towards a seller's market for all of these cities on average. So that's something to note. But Chandler is leading the pack with the CMI in the 200s. We haven't seen any CMI in the 200s in quite a while. I'd have to go back and find out when the last time that was, at some point towards the end of last year or last summer, more than likely. And then Buckeye is bringing up the caboose, so to speak, and at 66.4. So that's where we stand with the CMI. I also wanted to share a few notes that they just updated as far as iBuyers and investors, because it's been a bit since I've talked about them, and I get a lot of questions about what's going on with Opendoor and OfferPad and, all these iBuyers. So let's take a look at the notes that they've shared. And hopefully you can see all of that. I'm out of the way there. Perfect. Okay. Opendoor purchased 20 Maricopa County homes during February, but sold 243. This was their best-selling month since September of 2022. So good news that we're seeing Opendoor purchase less than the number that they're selling, because they have such a large number of inventory that they need to sell off. Now, I haven't worked with Opendoor in a couple months, so I'm not sure personally how they are selling these, if they are being more flexible now, and that's why they sold them. I think some of this is because we did see larger sales in general in February because of the uptick in activity in January. OfferPad purchased no Maricopa County homes at all in February, but sold 65. This was their best-selling month since May of 2022. So OfferPad finally seeing a good month for sales since things changed. Large-scale institutional investors are buying far more than iBuyers, with 118 acquisitions in February. This is far below February of 2022 when they purchased 531. So they're not saying when the last time they had this many acquisitions was. However, that gives you an idea of the difference between last February and this February. Wholesalers are active again after 4 months of low volumes. They had 110 closings, only slightly below the 127 we saw in February of 2022. That's interesting because that is that's not far off, 110 to 127. And with all of the changes that we've seen in the market, and wholesaling is, I guess they're getting some good deals to be able to turn that many around and sell them for higher prices in this environment. REO sales, pre-foreclosures, short sales, and trustee sales all remained very low during February. No sign at all of a wave of distress occurring. So that's the latest from the Cromford report as they break out different types of purchases and sales, especially on the investment side, and thought that would be useful information as it just came out. So you guys, thank you for joining me this week. If you're new here, I'm Caitlin McKegg. I am a real estate broker here in Phoenix, and I'm here every Monday going through what's going on, not only in the economy, but what's happening in Phoenix real estate to help you make decisions on buying, selling, or investing, or even renting. So if you have any questions, reach out to me. Check the description below. I have some links where you can set up a time to chat or check your instant home value or search my MLS for homes, whatever it is you're looking for, and hopefully that's helpful. So I'll be back later this week with some more info, and make sure to catch me here every Monday at 4 o'clock. Have a great week, you guys.